Yeah. So a very important field of research is that, is it so that the companies who commit frauds, who are doing all kind of manipulation to their accounting and financial data, is it sustainable? Can a company live on a falsehood for the rest of the life? Can a company do corruption and nobody knows it and eventually company keeps growing and progressing? No. It's like sand in the hand. It will eventually fall down. No matter how strongly you hold it, it will come off and people would know that you have done something wrong. Today, the idea is that in one spreadsheet, I would be discussing how you can check the financial reporting quality. You can quantify it. Look at the word, financial reporting quality. But we can measure it, we can quantify it. And the model that we use to quantify is called Beneish Model. It's a very famous economist, very famous accountant rather, accounting researcher, and it's a globally accepted model. Not only the researchers use it, even the companies use it, right? And then, does this lower or higher quality of accounting data have an impact on the likelihood of bankruptcy? So in other words, I'm saying a company who have a lower quality of accounting data is more likely to become bankrupt. So there is a negative correlation between the financial reporting quality, right, and the probability of bankruptcy. In other words, a company who have bad data is more likely to become bankrupt, and the company which have very high quality of data, they have the higher probability of survival or sustaining and progressing. So there is a negative correlation. So I would be using, in today's lecture, does financial reporting quality have an impact on bankruptcy? So if I can say so, those companies who have the lower quality of financial reporting, they have bankruptcy likelihood. So those companies who have the lower quality of accounting data, they do a lot of hanky-panky and manipulations in their financial data. They do all kind of things. Then they have a higher chance of becoming bankrupt. i.e., that is, if a company have a higher quality of financial reporting, then they have a lower probability of bankruptcy. So bankruptcy likelihood and the quality of financial reporting have some kind of negative association. Like now, both are qualitative phenomena. Financial reporting quality itself is a qualitative phenomenon, but we quantify it with the help of Beneish model. It's a very good technique you can use in your thesis, or those who do in finance, if you want to see some aspect of how likely a company or a bank, for example, Henrika used it while doing risk management of Nordea, that how likelihood is that Nordea can become bankrupt company, right? And how good is the financial reporting quality of Nordea? And here we measure bankruptcy thing, likelihood, with Altman Z score. This is Beneish M model, because of his last name, and the first name, sorry, and the Altman Z score. So first I shall study the cause variable, because this is the cause and this is the effect, right? And we look at the cost variable first. And to see the cost variable, we need to look at the Beneish model. The Beneish model is here. It's uploaded already. You can see in your Optima. And I even, this is a source of information where I got this data from. Sorry. Now, please remember, why I'm calculating Beneish model is to find that how good quality of financial data the company has, okay? And these are the inputs, what we need to get. Look, you have got all this information in your accounting course, and you can see that, okay, let's have a small quiz. We have to calculate Beneish model, we have to have a comparison between 2 years, right? Because it's based on the changes. To make a change, you must have 2 periods. So that's why there are 2 periods, 2008 and 9. Net sales, you know what is net sales? Is total revenue, right? Or the net revenue. The total revenue minus sales returns are called net revenue, even though I don't care between them, because for a company, the returns are very, very, very minimal. For any MNC, the returns will not be more than 0.01%. So it doesn't matter. You can take total sales. It makes no difference. Question is, where you get this information from? Which accounting statement gives you the info? Remember, we have 3 statements. We have income statement, we have balance sheet, we have cash flow. Where do you get the information about sales? Income statement, of course. Then comes cost of goods sold. Again, income statement. Because the difference between revenue and cost of goods sold will be giving you profit. And profit is always in the income statement. Net receivables. What are net receivables? Huh? No. Well, the question is that you're right, net receivables are in the balance sheet, but the point is that what are net receivable mean? Or what is receivable means to you? Receivables are, do you think that all the companies sell in the modern world on cash? Oil company, some Saudi oil company is selling oil to a country, and then the importer are filling the notes in a suitcase or in a ship, and they're sending notes to the country, to the Saudi company, please take the cash and give us oil. Do you think things happen like this? Or is it so that you take the card, you go to the oil company's office, you say, we want to buy 35 million barrels of crude oil, and this is my card, can I swipe it? Where is your machine that I can? No, we buy things on credit. And sometimes the payment can happen after 2, 3, 4, 5 years. But in accounting, we record as a sales the moment transaction takes place. We don't care when the cash will come. That creates difference between income statement and cash flow statement. All right. If you are a company, for example, if you go to Prisma, there'll be hardly any difference between their income and the operating cash flow. Guess why? Because you never borrow things on credit from Prisma, do you? We make the payment then and there. But if you are a company making some jumbo jets, or if you are a very big oil company, or you're a mining company, don't expect people would pay you then and there. All right. So, for example, I make a sales of $20 million today. I will record it as in my income revenue 20 million, even though I receive it after 5 years. But in my cash flow, I will not enter these 20 million until I receive them. All right. So that creates a big gap between your income and cash. So the receivable, so I will call them receivable. Receivable mean I'm going to receive from them. All right. I will not call it cash. I will call it receivables that I would be receiving. And where you find them, May has said that they are in the balance sheet. Very right. In the balance sheet, there's a heading called receivables. If you have to receive money from people under 1 year, they are in the current assets. But those people who will be paying you after 1 year, they are in the non-current assets. So they are assets for sure, but depending upon that, because in finance and accounting, we have a cutoff line of 364 days. If you are less than 365, it's a current period or the short-term period. And if it is 365 and above, it's a non-current or long period. So those people who would be paying you after 365 days, they would be appearing in the non-current assets. So while you check your receivables, check both in the current and non-current category. All right. So the current receivables and the non-current receivables. The current assets altogether. The property, plant, equipment, PPE, we call them as an abbreviation. Property, plant, and equipment. We need a separate value. And where do you find them, by the way? PPE. Where can you find property, plant, and equipment? Sorry? In the balance sheet, where? Assets. Which assets? Current. You buy a property, you buy a building, it stays with you for 30, 40, 50 years. Is it a current asset or a non-current asset? In the non-current assets, the property, plant, equipment are generally long-term assets, means the non-current assets. All right. So be precise. PPE in the balance sheet on the asset side, in the non-current asset side. Depreciation. What about depreciation? Sorry? Not all fixed assets. For example, if you buy an automobile, it's a fixed asset. Fixed not in the literal sense that they are rigid, they don't move. Because the fixed is that you buy it, it stays with you for a long time. You buy a car, it stays with you for at least more than a year, right? But it's not PPE, you know? So you can have more non-current assets which other than PPE, right? Make sense? In that case, yeah. Yeah. Depreciation. Do you know something about depreciation? Yeah. So when you buy an asset over the time, its value diminishes, right? Remember, it's not depreciation that you, yeah. Yes. Yeah. It's always the accountants, they decide that if you buy some long-term asset, yeah, you have to reduce, you have a certain economic years. Like, for example, when you buy a car, we can say that, let's say we decide, we have a consensus that economic years of a car are 20 years. And let's say you buy this car for 30,000 euros. And if you think that the economic life of the car is 20 years, one simple rule of thumb formula is that divided by 20, which makes 1,500. Yeah, show it as a depreciation. So what happens in your accounting, in your income statement, you show 1,500 depreciation as an expense. And after year one, your property, which is an asset, it's an asset, remember, car is an asset, but the book value of the asset next year would be 28,500. When you buy the car now, year zero, the asset is 30,000. Depreciation is nothing because we just bought it. But after 1 year, if we have assumption that 20 years is the car's life, then in your income statement, you show 1,500 as expense which you have not incurred. Remember, when you pay depreciation, do you pay depreciation, by the way? Do you pay it? No, it's a it's it's an incurred expense, but a non-cash expense. You never go and take 1,500. Hey, take my depreciation. That also creates a difference in the income statement and cash flow. Your cash has not left the company, but your profits have gone down by 1,005. Doesn't make sense or not? Profits go down by 1,500. Actually, no cash has left the company. All right. This is called depreciation. Yeah. There is something else called for the amortization. Yeah. Amortization, we use a phrase. Depreciation is for the fixed assets, but the amortization is normally for if you have a software or a form. Like, for example, GlaxoSmithKline develops a drug, and the drug life is 20 years. And then they say, hey, after till 20 years, only we have the right to manufacture this drug. But after 20 years, this drug will go off patent. And then you can make it in India, China, wherever you wish to. But if you want to manufacture this drug before 20 years, take a franchisee from us or pay us a license fee or whatever. But who knows, after 20 years, the drug has no effect. But anyways, the drugs can go off patent. Total assets are total assets. Needless to say, total assets are total assets. These total assets are also called the book value of the company. If somebody asks you, what is the book value of the company? Then look at the total assets. Sales, general administrative expenses. SGA, we call them SGA expenses. You can see here. Sales, general, these are not the expenses which you require to produce this marker. If I produce these markers in a factory, it doesn't include the plastic, the chemicals, the rubber, or all that stuff. This is more about sales. Like when you sell something, you incur some expenses, don't you? From the one delivery point, you have a complete, what is that word called? Value chain. So you're delivering the trucks, the lorries loaded with the markers to, let's say, to Tampere, and from Tampere it's supplied to different parts of that part of Finland, and so on and so forth. Or you have an office, you have the files, you have the computers, you have the stationery, general, administrative, you have a administration staff. I mean, this is very simple. But that's not your main operating, these are not your manufacturing expenses. Sorry? This is part of your operational cost, because unless you have them, you can't operate. Remember, manufacturing cost is not same as the operating cost. All right. If you have only manufacturing, if you don't have the office, how do you operate them? You don't hire an accountant, you don't have a clerk, you don't have all these people who help you carrying files, looking after the visitors. All the expenses are included in that. Administrative expenses, yeah. And then we calculate. Sorry, did somebody raise his hand? Yeah. No, it's included in the income statement. No, these are some other, when you look at, you have to look at because there's no one, you have seen in the management accounting course, companies don't use the same phrase for everything. You have to see, you have to detect. But if you know the idea, you can detect it. They can call it some operational expenses. They can call it some administrative expenses. It could be possible that all these SGA are covered under one expense called administrative expense. So you have to find it out. Yeah, well, you have to locate them. You have to detect, they will be there somewhere, don't worry. And the net income is your net profit, right? The net income is your net profit here. Cash flow from operations is, this data is very easy to get. Just go to the cash flow statement. There'll be a separate clear heading called cash flow from operations. All the companies in the whole world would be having this category called cash flow from operations. Pick up as such, no calculations. By the way, Cash flow statement has three pillars. The one is cash flow from operations, like selling and stuff. Look, for example, let's take the example of Prisma, right? When a customer comes to a till point, come to me, give me the card, I swipe it. This is a cash coming in from operations. Same way, Prisma buys the stock from the suppliers and if they make a payment, that's a cash outflow from operations. The other is cash flow from investments. If a Prisma want to start a new outlet somewhere nearby, and they have a building, they buy the equipment, all the machines, look at that. They have to invest so much in the IT sources, the filling machine, the whole decor, everything. Proposition. That would be cash flow from investment. That will be cash flow from investment. Normally, your cash flow from investment is negative because you spend money. Money goes out, right? And another cash flow is cash flow from financing. If I'm representing Prisma and I want to start a new outlet of Prisma somewhere nearby, I need money. Where does money come from? Well, this money comes from shareholders, banks, etc., etc. This money coming in would be called cash flow from financing. Cash flow from financing, cash coming in, cash flow from investment. I use the money by investing, spending, but the real cash flow, which is an indicator of your efficiency, how efficient you are, how much revenue you get, is cash flow from operations. Okay, and then we have the current liabilities. That's pretty okay. It will be in the liability side, and the long-term debt. Simple. Okay. So now you know which are the inputs we require to calculate and make a comment how good the quality of your financial reporting is. Disclaimer, this is only one among various measures to check financial reporting quality. Make sense? Okay, but this is one measure which companies use quite often. It's a very applied mean of checking the quality of reports. Okay, now you have the data. Now you need to calculate some indexes. You can see there is a day sales receivable index, gross margin index, GMI, asset quality index, sales growth index, depreciation index, SGAI index, leverage index, total accruals index. So we need to find out these indexes. But once you have this data, life becomes very easy. There are formulas here which you can use to calculate them. All right. So there are formulas given in the spreadsheet. Now you have the input. All you need to do is fix the information and find these indicators. For example, the other long-term assets. So it's like a C12. What is C12? Total assets minus C10, the property, plant and stuff, minus C9, the current assets. That is your other long-term assets. So the other long-term asset is that you have total assets minus property, plant and building equipment, whatever, minus current assets, then whatever is left over is the other long-term assets, other than property, plant and equipment. And then we have the DSRI, which is depreciation. All right. So what is D8? Well, D8 is depreciation. No, sorry. D8 is your net receivable. No, DSI is day sales. Sorry, I mixed D with depreciation. And the point is that you will be using these calculations and so on and so forth until same way. How how good quality of your asset is. It's an asset quality index, D20 divided by D12 and C20 by C12. Remember, C is the previous year and D column is the current year, okay? So D12, D20 minus D12. So we have a D20 minus D12, which is total assets. And likewise, we keep the calculation. And then what we do here is, you can use the 5 variable model or the 8 variable model. The last thing I want to discuss with you is accrual. So once we calculate these things and you fit in them here, you will get a number. Guess what? Minus 4.84, 0.90, 0.528, 0.404, 0.8892, and so on. These are constant. They are in the formula. You get the point? So if I ask you that please memorize the formula, you cannot. Because first of all, there are 8 variables here, and these numbers are fixed. They are inborn, ingrained in the formula. So you can't change them. But then just multiply, for example, DSRI. Just multiply DSRI. Where is your DSRI? Here is this one. With what? With 0.90. GMI. GMI is gross margin index, which we calculate here. Multiply GMI here. AQI, the asset quality index. Multiply 1.497 with 0.404. So this is given, okay? You can't change it. But the point I'm trying to make is that when you make this calculation, you reach at some number. For example, if you use the 5 variable model, you'll be getting, based on the given data, you get this one. But if you have the 8 variable model, you have minus 2.23. And the indicator is that if a company, this is the M score, yeah, with the 8 model and with the 5 model. If M is more than a legend minus 2.22, if M is more than a legend minus 2.22, the firm is likely to be a manipulator. It means that the company is doing some manipulation with the accounting data. And here you can see that with the 8 variable model, your M is minus 2.23. You get my point? The M is minus 2.23. Let's focus on 8 variable model. Minus 2.23. And the legend is minus 2.22. My question is minus 2.23 more than minus 2.22 or less than? Less than, because if it's a negative sign, the interpretation is, so this company almost escaped from being labeled as a manipulator. So this company could have been named and shamed. It just escaped. So if M is more, now imagine its value would have been minus 1.91. Then this company could have been labeled as a manipulator. Make sense or not? So all we need to do is, you have this inputs data, net sales, all this, and then based on that, you calculate these indexes. All the indexes are given here. How to calculate them? Very simple. Okay. There's hardly any company which doesn't supply you these data. So all this data are very simply available in the income statement or maybe in the balance sheet, and one information you get from the cash flow statements. And all you need to do is you need to fit in in the calculator, in the formula. And based on that, make the calculations. And once you have these indexes, fit into, I prefer 8 variable model, fit into the model, and these numbers are given. These are discovered by Benish and made constant. So these are the constants. For example, we use the value of pi in mathematics as 3.14. It remains constant, right? So these are the constants there as well, and they remain same. But all you need to do is multiply the numbers with these constants, and then you find the number value. And if the value you find will be called m. So this is m, and if this m is more than minus 2.22, you can call a firm manipulator. Yes, yes. When Benish discover this model, he used this analysis called, there's an analysis called discriminant analysis. And he discovered that whichever company he takes, whichever data he takes, these constants remains constant. They don't change. They're just numbers. There's no explanation, there's no logic. They are in the formula. All right. So that's why I'm saying that you need to know the formula. You don't have to remember it because you can't remember all these. So for example, now these numbers would change. Leverage would change. Assets would change. SGP would change. They all would change. But these numbers will not change in the equation. Makes sense? Because these are constant found by Benish in his model. Well, we can disagree with his model, but the model is, if we agree with this model, then these numbers remain constant. They don't change. But for example, your indexes will not remain same. If you do it for BP, they would be different. If you do it for Marks and Spencer, if you do for Prisma, these numbers would definitely change. The indexes would change, but the constant would remain constant. And then we fit these numbers. Yes. All when 001 difference between the manipulator and M score. So almost a minute, or it's you can make an interpretation. Look, if this number was minus 4.68, if this number was minus 4.68, you can say that, hey, it's far away from being labeled as, but here it depends upon how you interpret that there's a tendency towards manipulation. Yeah, yeah. And then you can say that, you know what, even though the company has survived, or the company is not having the bad name, right? But it could have had a bad name. It's a bottom line escape. Like, for example, the passing marks are 45 and somebody gets 46. The person passed, it's a pass, but still, it was you're living on the edge. Make sense? So depending upon the magnitude of your M, which you find, and the legend would determine how far you are from being labeled as a manipulator. Make sense? This is what Beneish model tells us, that how we can name and shame the manipulators. This company survived, but you can see that survival is not real survival. It could have been labeled. Just one couple of numbers change would have been something called something else. Yeah. Mm-hmm. Well, then it depends upon which model we accept. I would say 8 variable model is better than 5 because more variables. The one thing we must remember in statistics or in research that more variables, more data is better than less variables and less data. So that's a rule of thumb. More variables means more explanatory power of the model. Mm-hmm. So more variables indicate the explanatory power of the model is more because you are considering more aspects. In the 5 model, you are ignoring 3 vital aspects. You assume that as if they don't exist. How can you make something existing? How can you assume it as a non-existent? So you are blocking the impact of 3 vital variables. But in the 8 variables, you bring them in. So 8 variable model is, of course, better than 5 variable model. Okay? The next thing we are going to measure is that how probable a company is to get bankrupt. So for example, if you are a company and you get an order from another company, you're an X company, the Y company places an order to you and says that, could you supply so many thousand units of your output? But you know what, we will pay you after 6 months. You're happy, you got a new order, but you should be careful. Is this company a Ponzi company? Is it cheat company? Is it really a company which you can have a business with? So in that case, it's not a bad idea to calculate early, very preliminary diagnose is that you apply Altman Z score and check how probable is the company to become bankrupt. If after 3 months, this company become bankrupt and you sold the goods to the company and they promise you to pay in 6 months time, guess what happens? You lose money. Then you should also calculate your own Altman Z score because you can also become bankrupt. If you're a company and your 3 major clients have become bankrupt, would you survive? Bankruptcy is contagious. Have you seen the 2007 crisis? Subprime mortgage, home mortgage market. Banks are having a competition to woo the customers who will buy the houses. And in the process, they don't care about checking the credit worthiness of the customers. And they end up giving loans to people who shouldn't have received loan. And guess what happened then? They didn't pay. They didn't pay. One bank didn't get the payment. The one bank got bust. The bank owed money to another bank. So in the whole chain, what happens? There was a complete banking failure. Okay, so therefore, this is a very important tool where you can check. Remember, it's not a final in-depth analysis. It's a very practitioner kind of analysis, but very useful tool. Altman Z score. First of all, let's check what type of inputs we require. First of all, unlike the Beneish model, you don't need 2 years. You can live with only 1 year's data. Okay, you can see here, you need net sales. Look, here the source of information is also given. From the income statement, you need the net sales and operating income. Operating income is also called operating profit. Does it make sense? Operating income is also called operating profit. And the real technical name of operating profit or operating income is called EBIT. EBIT is earnings before interest and tax. Some companies use the word PBIT, which means profit before interest and tax. Okay, so you need to know the operating profit or the operating income or EBIT or PBIT, whatever you call it. And the information is coming from your income statement. From balance sheet, you need current assets, the full block. of current assets, total assets, current liabilities, total liabilities, and the retained earnings. Can somebody tell me what are retained earnings? Retained earnings. Yeah, go ahead. No. Retained earnings are that part of profits which you don't share with the shareholders. Yeah. Remember, when you have the profit, what do you do with that? Is it the money which goes to your pocket straight away? No. First of all, from the gross profit, you pay tax. That leaves what? Net profit. And then from the net profit, you share some profit with the shareholders, but not all the net profit. You keep some profit for yourself, for the company. For what? Because there could be some emergency issues. There could be some problem next year. There could be something negative happening to the company, and you have a buffer, you have a resource which you can utilize to make sure that you can withstand any crisis in the future. It's like the saving, you have an income, you pay income tax, the carry home, the salary, you carry the money the home, but do you spend all of them? You keep some savings. So these are basically corporate savings. So imagine a company has earned 200,000 profit. Tax is 10%. They pay 20,000. Then what is left out? 180,000. Then they make a deal with the shareholders. Hey, this is our profit, but you know what? I can't give you all money because I need to. The good reason is that I want to make an investment in the future. The bad reason is that what if there's a problem? How would I survive? I can only share 100,000 with you so that this 80,000 euros remain in the buffer, in the saving. This is called retained earnings. Retained mean retain. Well, the name itself is self-explanatory. You retain them. You don't give them, you retain them. That earnings or the profits which you retain and don't distribute is retained profit. All right. And then for the public companies, we need to look at the market value of equity. The market value of equity. How do you see the market value of equity? Is there any way you can check the market value of equity? The market value of equity is that you just need to go to some website. First of all, these are public companies, not public sector, public limited companies. These are private companies, but available on a public stock exchange. Nokia is a private company. For example, let's say Microsoft is a private company, but it's a public company. It's a private sector company, but a public company. Why? Because public can invest in it. They can go to the masses. Hey, invest in my shares, invest in my bonds. So any company which can approach public for its funding is a public company. It doesn't mean that it's a public sector company, right? Public sector is which is a state-owned sector. Well, the public sector company can also be public company. State-owned company can also be. But it has nothing to do with the ownership, that who controls them, state or people. Anyways, I want to show you one example. If we go, for example, to Reuters, And I want to look at the for instance, am I showing it to you, by the way? Is it visible to you? This one. Am I sharing the screen with you? Oh, yes, I'm sharing it with you. So if I type here. Marks and Spencer. The market value of Marks and Spencer, according to today's data. Remember, the market value changes every day because the market is working every day. The book values only change after 3 months because you publish the quarterly report, first quarter, the mid-year, third quarter, and the last year, the final report, yeah? But the market value you can see every day, every moment. And according to the latest data, the market value of Marks and Spencer is 5.6 billion pounds. So this is, you can see here, 5.6 billion pounds, like in the pounds, and the data is in millions. So it's like a 5,600 something billion, 5.6, billion. But if you want to look at the, now imagine if Marks and Spencer was a private company, means it has no shares listed on the stock exchange. It was owned by 2-3 people and they would run the company. Then just look at the total assets of Marks and Spencer. That would be the book value of the company. Okay? The company doesn't exist in market, so how can you calculate the market value? Market means the stock market. The company exists in the market. In the product market, it exists, but not in the capital market. So you have to exist in the capital market to get the market value of the company. So Marks and Spencer, had it been owned by 2-3 people, small company, not listed in London Stock Exchange or any stock exchange, then I would only look at the total assets value, and then I would say, okay, this is the value of book value of the company. There's no market value for that. So now we have all the data of this. Okay, so for the public listed companies, we use the market value of equity, but for the private companies, we use the book value of the company. All right. And I'm sorry, I made a small mistake. If Marks and Spencer is a private company, all right, so there's no market value, then the book, I was thinking it's a book value of the company, but it says book value of equity. The book value of equity is equal to total assets minus total liabilities. Disclaimer, apology, correction. The book value of the firm, I remind you, the book value of the firm is total assets value. But the book value of equity of the firm, if it's a private company, not listed, is total assets minus total liabilities. So correction. Sorry, I thought it's a book value of the firm. It's a book value of equity, okay? So book value of equity is equal to total assets, which are here, minus total liabilities, which are here. And look here. Again, we calculate the indexes. Can you see here? Factors are calculated. Factors we calculate. How we calculate it? The working capital is equal to working capital to total assets. The B9 is current assets, current liabilities divided by B10. These are the financial ratios. If you remember, we had once upon a time course called Management Accounting. And in that course, we studied financial ratios. All right. So these are that financial ratios. So we have a working capital. And then we have the retained earnings to total assets. Well, it's simple. You have the retained earnings divided by total assets. And then we have the EBIT to total assets. Divide EBIT by total assets. Liabilities, market value of equity. So basically, you need to find these 5 ratios. All right. And look at these numbers. Do they change? Do they change these numbers? Is there any formula where this 1.2 come from? No, because these are constants. Remember, we had the constants in Beneish model. Altman also gives you some constant values. Okay, if you want to know where they come from, please ask Altman, not me. You can email him and check why these numbers, because he would say that when he did large experiment with thousands of companies, dozens of years, then the final conclusion he drew was that these numbers are constant. Okay, so let's live with them. And then what we do? We multiply. And how we multiply? These values you calculate. They would take the company and for year to year. Okay? These remains constant. And when you multiply them, and add them up, we get 3.35. Huh? For this specific company for this year. So even if you have the same company for 5 years, you differ. Maybe you are less likely to become bigger last year. So the company compared with itself over years, or the company in a year compared with the other company. Yeah, yes, exactly. Precisely. It could be possible that this year things are not so bad, but if you look at the last preceding years, things were bad. So it means you have, even if you are safe, but be careful. Sorry? Is good or bad? I'll come to that now. I'll come. But do you know that where they come? The point is that the column C, please have attention. The column C you have calculated. Column D values are constant. Okay. And the formula is we multiply each value with the corresponding constant. So this multiplied by this, plus this with this, plus this with this, plus this with this, plus this with this. Remember, this company is in this example, the company is a public company, yeah? That is why there's no calculation made for this cell. Can you see it? Why? Because the company cannot be public and private at the same time. Do you know what I mean? So in this example, we assume the company is a public company. Therefore, the company is either public or private. Therefore, this whole row 26 is ignored. Okay? If the company were private, then row 25 would have been ignored, and we will take row 26. 3.35, good or bad? Remember 3.35. Z score about 3. The company is safe based on the given numbers. So based on your very basic diagnostic test, Remember, it's a diagnostic test. It's not like a deep, it's not that you are doing patient's ECG straight away. It's like when you are using the thermometer and the blood pressure and the basic blood check. So it's a very basic preliminary diagnostic. It's not a cure, but it's more like a diagnosing something. And that too, very early stage, very early check of diagnostic things. So the value is more than 3 is good. Between 2.7 and 2.9, and keep on vigil, be careful, on alert. Okay. So if it is between this range 2.7 to 2.99, you have a reason to be careful. It's like a alert. 1.8, 2.7, good chance of the company going bankrupt within 2 years of operations from the data. So you can assume that if this is 2018 data and the value is 1.9, you have a good reason to believe that this company would not exist in next 2 years' time. So again, it's a rule of thumb interpretation. So let's say the value is 1.9. Don't deal with this business, with this company. If you deal, then take the money before 2 years. And if it is below 1.8, it's like a flood warning or like a tsunami warning that it can come anytime. Don't deal with this company. So you can also, as a company, when you form your strategy, you can make a rule that we will not do any business with a company whose Z-score is below 2.7. So you can make an internal rule. This is called control, internal control, that we don't, if somebody asks you in a company, hey, what type of companies you deal with? Do you supply things to anybody? No. We calculate Altman Z score, and on the basis of that, any company whose zeta Z score is below 2.7, we have no business with them. Okay, so these are legends, benchmarks, criteria. Yes, sir. It's applicable to all companies except the financial companies, not banks. No. As long as it's a company, it's a company. Yeah. We don't use it. It's for the established companies, not for the startups. Last year, we did the valuation of a startup company, the same company who you see next week, Memorandum. And we applied this technique also. But then we modified the formula slightly. The students, and that was their creation, that they modified the formula itself so that we don't apply the same formula on them, because that will be unfair. Okay, so it's a good topic of research that you have the companies, you categorize the companies in sectors, chemical companies, aeronautical companies, all right, pharmaceuticals, and then over the years, and could also be possible over a country, like German companies vis-a-vis Finnish companies vis-a-vis German companies, or Russian companies. So you can have different sectors, different years, different countries. So make some subsamples of those companies and then check, do these bankruptcies of the companies are affected by the quality of data? Because if a company is doing corruption, you can do corruption in many ways. But if you have to estimate corruption, then the best estimation is look at their financial statements. It's almost impossible a corrupt company doing no manipulation to its data. Well, they can't do corruption in that case. You get my point? So the quality of financial reporting measured by Beneish model tells you how honest you are. And does your honesty or attitude of manipulation determine your bankruptcy or not? That you do with the Altman Z score. So you can have a set of companies. It's a good quantitative research, not deep regression stuff, but basically all based on the formula. So sets, subsets, calculate Beneish model for one companies, but the same companies calculate Altman Z score and see how they fit in and make a conclusion. So that's everything about Altman Zeta or Altman Z.